never know. But 95% of startups fail.
It's almost harder to do that 5-year plan or 10-year plan. Be realistic with yourself.
How much pain am I willing to go through to get to that end goal?
Welcome to the next episode of the Entrepreneurial Excellence Podcast. I have an awesome founder, investor, leader with me today, Zack and Onisko. Many founders dream of scaling sort of one great company. Zack has done it again and again, not just building startups, but turning them into category leaders in cash flow positive kind of machines, which is pretty badass. At Dribbble, which many people know from the design community, Zack took what I think was essentially a designer's side project and bootstrapped it into one of the world's largest creative communities with over 20 million users, 35x in revenue, 100x in EBITDA, did 6 acquisitions, and built a really positive remote first culture long before that became the norm, which I would love to talk about since I'm a huge proponent of remote, but you might have a different perspective now in a different world. At Creative Market, Zack walked into a company bleeding $3 million a year, and within 3 years was turning it into, was doing $7 million in free cash flow. He added powerhouses like Font Spring and Font Squirrel, and kind of reshaped the digital asset marketplace. And then finally, as managing director at Enduring Ventures, Zack is focused on acquiring and scaling tech businesses with the same philosophy that you had as a founder, really focusing on enduring growth and helping some of these companies that may be overraised or have overly aggressive cap tables now, and helping them still find an exit and an opportunity to keep their dream alive. From garage startups to global platforms, Zack has seen highs and lows and the exits, and he's here to talk through some of these hard-won lessons. So Zack, welcome to Entrepreneurial Excellence.
Adam, thanks for having me. See you again. Awesome to be here.
Good. Hopefully that wasn't too embarrassing with that intro. I always ask people right off the bat, and if I don't do it off the bat, I always end up, we get too deep in many things. You've been such a successful investor, founder, everything else. How do you define entrepreneurial excellence? Like, what does that actually look like to you?
Entrepreneurial excellence mean to me. So I think that, I'm a Bay Area native. I grew up in Silicon Valley, and, I grew up thinking business success was revenue growth. And that was just such a North Star for all the startups that I've worked at. And, it was really at Dribbble when we decided not to raise venture capital that, felt ownership in the business, that's, really discovered that profitability and sustainability was, really what's core to entrepreneurship. And you get outside of this tech bubble we're in, you get outside of San Francisco and move into any other business in America or the world. And that's basically what a good business is. And a good entrepreneur is somebody who can sustain, profitability over many years, if not decades, or generations. So, I mean, that's what comes to mind is really, an entrepreneur, an excellent entrepreneur, growing a business, that's definitely a piece of it, but growing a sustainable business, that's the excellent part.
And is the thesis, I think, for a lot of Silicon Valley folks is it's actually not about the long term. It's about sort of a short term win. And short term might be 8 to 10 years, but getting a win in the short term, irrespective of the long term consequences.
Look, I think it's just the nature of the beast of like the venture model, right? And so, we came from an era in Silicon Valley where you needed capital to buy servers, to invest in really expensive engineers. We're coming out of that cycle now where it's, cheaper and easier to start a business than ever on the internet. In that era of venture capital, what call it like last 25 years or whatever, the model is shaped for growth, right? So the model is like 1 out of 10 businesses that they fund will become this, 100xer. Maybe 3 of them will be the fund returner, but the model is shaped in that direction where like some percentage, of the companies will go to 0, but all of them are aiming for growth at all costs. And so that growth at all costs model is what burns out what could have been good companies. I mean, there's a lot to that equation too. There's product market fit. There's, there's competition and market changes, and running a business is definitely not easy, especially starting a new business and a new segment. But no, I mean, I think that's kind of been my perspective shift, especially after, my experience at Dribbble and moving into Enduring and the companies that we're looking to buy. And Enduring Ventures is, really kind of shaped for that, what are the businesses that'll be around for a long time.
So what are the companies that look like they have an enduring, to use the term of your firm, but like what are qualities of enduring, sustainable, long-term businesses that founders should maybe shoot for? And actually, maybe before you answer that, should founders look to build a long-term sustainable business, or should it be growth at all costs? And it might be different kinds of businesses we're talking about, right? Some of them, the tech VC-backed businesses, maybe it's growth at all costs. But maybe for the majority of businesses out there, the goal is not that growth, it's to build something enduring. So maybe how do you break those up? Is there different types of businesses and what they should target? And then what are the qualities of those enduring businesses that truly are outlier success stories or can become an outlier success story?
I think most businesses are enduring, right? I think if you look into the yellow pages, or you look in your local town guide and you look at businesses that have been around for 20, 30, 50, 70 years, there's a lot of those enduring businesses. And it's like everything from like insurance to plumbing to real estate, mortgage lenders, like whatever, right? And so, in Silicon Valley, we innovation and doing the next latest and greatest and trying to find a new market and a new thing for people to buy. I think that's where there's a lot of risk and uncertainty in that product market fit puzzle. And so from like the startup perspective, I think it's harder to know if you're building a sustainable, enduring business, if you're doing something net new, versus if you're building a business where there's customers, there's product market fit for this thing that you're selling because it's tried and true. Maybe there's competition, but what we've been led to believe in Silicon Valley is that it can only be one winner. And that's just not true in business. And, customers have choice of who they call.
Even in Silicon Valley, there's so many companies that have, even AI race, right? You have OpenAI.
Yeah. In their fundraising on that story, right? On who's going to be the winner, right? And so it's have a different mindset when you get into, the rest of America and other industries. I don't know if that answers the question, but I think that it depends. And, what I like to look for, I'm mostly investing in software businesses. There's obviously a ton of rapid innovation, the fastest innovation I've seen in my life with AI, and the landscape will definitely shift. And so I'm kind of looking for niches where, even if AI does accelerate parts of the market, it'll fundamentally change like the internet and just how I think it'll change society in the next 5, 10, 15 years. What are niche businesses that'll continue to have customers and continue to, be able to run sustainably, over some period of time.
In going back to the entrepreneurial piece of the question, what are the qualities of entrepreneurs, of the entrepreneurs who build these companies in a successful way, who can build a sustainable revenue company over decades? Is there an entrepreneurial quality, or is the entrepreneur itself actually, or him or herself, irrelevant to the long-term sustainable focus?
I think just building businesses is hard, right? And so if you find a business where you built a good brand, you have a customer base, you have product market fit for what you're selling, that's kind of like a lot of businesses. And then the next kind of chunk is like, okay, how do you grow it? How do you invest in marketing? And it's just always a challenge. We talked before this call, like, every day you wake up and your team, gives you a new challenge and you just kind of go put out that fire. And so, yeah, I think that entrepreneurs, just to be an entrepreneur, you just need to be tenacious. You need to have really thick skin. You have to be able to have the persistence to get through those challenges because it just never stops. And to say that, I think that entrepreneurship isn't for everybody, right? I think it's some people are just better employees and they're better just kind of like, hey, here's your tasks for the day, go do those tasks and, clock out at 5 and that's the life you want to live. Like if you're going to run a business, that's your life and you're always on and, that's just who you are.
So going to the Dribbble story, and we'll go through some of your history too, but let's talk about Dribbble to start, because that's obviously with a pretty big success and everything else. Like walk us through like how Dribbble started. Where did it get to? Did Dribbble, walk us through what happened with it, exit, why did you leave, all the other key things that happened with it. at a high level, and then let's dive into some of the details of how you built it into this, company that it really became.
I didn't found Dribble. Dan Cierel and Rich Lynette founded Dribble, and they're like backyard neighbors. And he was a developer. Dan was the designer, and it really started because Dan wrote this book back in the day on how to just write better code for building websites on the internet. And it was on the design conference circuit. And he was looking over people's shoulders, saying like, "Hey, what are you working on? That looks cool." Like, and then it turned into this private community to share, for designers to share what they're working on with other designers. And it kind of grew organically, over that first like 8 years of existence, up into the point where they sold the business, and they sold the business to what's now Tiny, tiny.com, which is owned by Andrew Wilkinson. And Andrew was the guy who brought me in as CEO.
How did you know Andrew, and like, why did he think you would be a good CEO for it?
So I knew Andrew for a long time. I took a stint as head of product and growth at hired.com, which was like a marketplace for for engineers. And we did a rebrand, and so we did a set of sent out RFPs to a bunch of agencies, and one of them happened to be Meta Lab. And so at that time,
Andrew's like design firm, right?
That's how he kind of came up. They were based in Canada. He came down to San Francisco and kind of get charged wherever he wanted, and it was incredibly profitable agency. And from those profits, that's how he kind of started his investor career. So Dribble was, I think, one of the first acquisitions, and Hired. So we connected with him through this Hired rebrand RFP. They were too expensive. We didn't end up going with them, but stayed in touch. And it turned out that Uber, which was like a floor above us at 11th and Market in San Francisco, was a client in Meta Lab. And Andrew's like, "Hey, I just bought this company. I think you'd be a great fit for CEO. Can you meet me for coffee in the lobby?" And he's like, "Yeah, it's like your background in recruiting and design. Like, I think it's perfect." I'm like, "Oh, did you buy your Dribble?" He's like, "Oh, no. I can't tell you who it is. I'll send you an NDA tonight, and then we'll talk about it tomorrow." And then his assistant actually sends me an email. The subject line says "NDA for Dribble acquisition." And then I was just so excited, right? Because I grew up as a designer. I grew up in that community, and that's what kind of attracted me to the internet. And from like making T-shirts for bands in high school to like making websites. And so at a prior startup, I actually strong-armed a designer I was interviewing, and to give me a Dribble invite just so I could join the community. And then fast forward a few years later, I'm the CEO. But I'm so excited after meeting Andrew. We didn't have any terms. We didn't negotiate, compensation or any of that yet. And I gave notice to Hired. I'm like, I'm 100% into this business. This is what I'm going to do. We haven't inked the deal yet, but you're going to hire me and we're going to do this. So that's the conviction I had.
Like, do you look for that sort of conviction in people you bring into your businesses too? Like, is that mindset one? Some people try to negotiate everything, or it's like, you know what, I'm going to get in bed with someone who I'm going to trust. And I bet Andrew probably appreciated that too. Said, okay, Zach's in, we're going to give him a fair deal, of course, and everything else. But like, we're just going to trust each other that this is going to be fair. And he's excited irrespective of the terms. And obviously you would have backed out if he gave you some terrible terms because he said, maybe I don't want to work with this guy.
We negotiated at some point, but that wasn't, we were going to come to terms. I wanted it, he wanted it. And so we figured it out. But yeah, I mean, when I hire people, it's definitely like, there's I think culture fit is like one of the first check boxes. Will I get along with this person? If somebody's too aggressively negotiating and it outweighs their value add, look, I'm not against like paying up for great talent. Like if somebody's like a 10x or 100xer to the business, like they're probably worth their weight in gold. But I have like negotiated people and like, yeah, like good resume, but you're like way outside of like the thresholds of what we can do here. And so
do you think when those people have that situation, is that just are they uninformed? And if yes, then like it's also a bad fit too, right? If they're just uninformed.
Yeah, I think so. I think they look at like, public company proxies and like, oh, this is what this like public companies where I'm like, that company has like $10 billion in revenue. And we're a little different when we're, doing 10 million in revenue. There's, I think there's some of that. I think there's some like just misinformation out there. But no, anyway, I think it's, also like shoot your shot. Like, if you're trying to look for a job and want to be heavily compensated, like, someone might give you that.
Was it like, this was exciting that you're just like, okay, this is Andrew's. Were you impressed by Andrew? Were you just excited by Dribble? Was it, hey, like I can also go be CEO versus, I forget, you're sort of like VP of growth or something it hired.
Yeah. So I definitely, it was all Dribble. So I think it was, I knew the business. I saw this like under optimized community that had a lot of traffic and had like amazing brand reputation and just love in the community. But it wasn't really a business yet. It just started to like dabble with some different revenue experimentation. And so I just saw a lot of dials to turn. And so from that perspective, I'm a growth guy. So I'm like, okay, how do we grow this thing? So, at the time I had like 500,000 users or something like that. And we scaled it up to like, 20, 25 million, when I left last year. So yeah, I was really excited about the team. I was very nervous. The team was like 8 people at the time. I just knew them all. Like I was like a fanboy, right? Some of the fanboy joining this company as CEO. And so I was just very like, just very like humbled by the opportunity.
What made you decide to take that jump though? So going from hired and give people a little bit of the background. I know a little bit of the hired stuff because I remember I knew their founders a little bit. And tell me if I got this history wrong. I haven't not researched it, but if I recall, they raised a ton of money. They were crushing it. Grew incredibly fast and kind of imploded almost as fast. But like, is that approximately right? Like it felt like they just went, they were this big flash in the pan. In like, but still to go from you being VP of growth, this fast growing startup to an 8-person company where you're CEO, but yeah, it's 8 people. Like that's a big jump for a lot of people that they might not take.
Yeah. I mean, I managed, 40, 50 people at Hired as a pretty big team. I think I joined employee 60 or 70, and I was only there for a year. And during that year, we scaled up to like 350 employees, offices in 17 cities around the world. And yeah, it was like a hyper revenue story, but also a hyper burner, right? And so we raised a lot of venture capital because our burn was so high. And again, it's just kind of a growth at all cost story, and that was the game that we played. Meanwhile, there was a startup in New York City who was founded by the CEO of Figure, the robot company. But at the time, he was like just building a scrappy recruitment marketplace and basically just copying every move we made. But we did it with 300 employees. He did it with like 30 or whatever. And he did it like with, I think he raised like 10 million. We raised like 130 million or something. Long story short, I don't know how much of this is public record, but I think it is. But, we were offered, like $100 million, offer to join Adecco, and our board shot it down because we raised a lot more than that. And so it was a bum deal. But it was a great deal for Vettery in New York. And so they took the deal. So they sold the business for 100 million. And, and those guys did very well on that transaction, personally. And then Brett actually the CEO of Vettery rolled his proceeds into like a flying car company that he SPAC'd and took public. And then he got a big nut from that one. And he rolled his entire proceeds from that into Figure, which is now like this massive robot company. That's pretty amazing to kind of see that.
This was the founder. So the founder of Figure basically was like doing all these things. He just kept rolling it into the next thing.
Yeah. But yeah, anyway, he was the founder of Vettery. And so what I was getting with that story is that,
how did Vettery be able to, they just copy you guys for far less money and more scrappy?
They took the New York market from us, and they were just like scrappier, and they did it profitably and sold the company, for a profit. Long story short is that when Hired kind of imploded was during the COVID era, right? And so it's, hiring kind of just stopped, and so the business stopped, and then Vettery actually bought Hired and then rebranded Vettery Hired.com. Yeah. It was it's a really crazy story. And now I don't even think it's anything. I think it goes to like another Adecco property. A learning lesson, just like the Silicon Valley, like, dream of like, is this going to be a multi-billion-dollar business? And we definitely had the trajectory, and it was going while it was going, and then it plateaued. So,
And do you think, what was a lesson learned when you think about once again enduring sustainable revenue businesses? Was it Hired went too big, too hard, too fast, but like it was the right decision at the time?
Hired lost product market fit. So they had product market fit for the first couple of years when there was like this heavy demand for hiring engineers in San Francisco, and is very, very competitive. And over time, that market demand shifted, and it became easier to hire engineers. People started to hire engineers in other cities, and now we're in this era where it's like, it's very easy to hire people globally. You don't need to hire somebody in your city. Like COVID kind of broke the mold, and now this whole remote, we're not limited by city or even like country anymore. We can hire, at least for now, until regulation kicks in. You can build workforces globally for a fraction of the cost you used to. Yeah, I mean, I think those are the forces that shifted that business. It was a macro change.
Yeah. And do you think that, so when you saw this happening, did you see this happening a little bit? Is that part of what made you go to take the Dribble offer? I mean, once again, like it's a big step to go from.
We were still kind of kicking ass at Hired. I was really just so excited about stepping in as CEO of Dribble that I kind of just dropped everything to go do it.
And okay, so that's what happened. You drop it, move from there. What did you find then? So you go into Dribble, 8 people. What are the things that you come in as like this outsider CEO that you're saying like, these are the things I would put in place? Like, what are the lessons learned there? Are there things that are still applicable today? Obviously, specific decisions, no, but like at a high level, what are those growth levers? You're like, hey, this is stuff that makes sense, that are the obvious things that founders don't do.
Yeah. So, I mean, I think that's, for a lot of internet businesses, you really have 5 channels for scalable growth, and you need to find out which is the channel for your business. If you're enterprise SaaS, it's most likely sales, with a couple of other channels that are like sub to that primary channel. There's virality, there's partnerships, affiliate, there's paid ads. And then for Dribble is SEO, right? And so we really leaned into SEO and into the concept of this being a UGC platform, and that UGC being the fuel that powers our ability to structure content in a way that makes it very efficient for crawlers to index our website, and for people searching for things on the internet to find our pages over anyone else's. And so that was kind of the name of the game for a decade or so.
Just SEO.
There's a ton of other stuff, right? Like we invested, but at the core, if you look back of like where we really doubled down, like that was a big part of the underlying story. We did a lot of just block and tackling, right? So like, working on our onboarding, working on being able to identify the different personas in the platform. Some people were there to hire designers. Designers were there to show off the work and find work. There were people who were just like window shopping, and we call them spectators. And so we built an ad model to monetize those users. And but kind of working through like, how do we build products for each of these persona types, and monetize each of those segments of traffic in ways that were valuable for those users. And so that takes a long time to really figure out how to do that effectively. Getting your pricing right, getting your packaging positioning right. That just takes a lot of testing. And then we also invested heavily in the design community, right? We had a podcast for many years. We invested in, content marketing. We had so we were a remote team. And one of the things we did, because we were bootstrapped, is we wanted to get the team together for, in person once or twice a year, but obviously it's expensive to fly everyone out and pay for hotels. And so we decided to throw a design conference. And we basically took all the profits from that design conference and used that as our T&E to pay for our employee travel. It's cool. And so, and then it's cool for the designers too, because they're out at this conference and like the entire Dribble staff is there, and you can just rub elbows with the community. And so it's really cool. But the best designers in the world were keynote speakers. And yeah, that was a lot of fun. But
Like that existed previously, I guess, in sort of the design community. There wasn't anything. So there was an opening for you to build a conference there.
there were other design conferences for sure. Yeah. But, Dribble had never done it before. I was just kind of like spitballing with a lot of stuff. I was trying to figure out how do I build goodwill and, just really try to solidify this community. So there's a night I was like, on Alibaba, like 11 o'clock at night, drinking some wine, ordered 1,000 pink basketballs, which was like our logo was a pink basketball. So I'm like, okay, we should probably have actual basketballs. So I found a ball manufacturer and, shipped without even knowing the whole, like how painful it is to receive, shipments from overseas. Ordered all these basketballs. I ordered like these crystal trophies for like the top 1,000 designers in the platform, and built an assembly line in my garage where my kids are helping me stuff boxes with these crystal trophies and hand writing the labeling and writing these thank you notes for investing in Dribble. And so did a lot of that kind of like what Paul Graham calls that non-scalable growth stuff, but it's handwritten notes and sending these gifts and like doing that. It doesn't scale at some point, but it goes a long way when you get like a surprise in the mail from a website that you're investing in.
Do people do that? I mean, it reminds me, we kind of used to in my company, Chore, do some of that sort of non-scalable stuff for our customers. Do you think that, like, is that still something you'd recommend for companies to do? Like, we don't have any new customers starting every month. Like, I could send a handwritten note and a small little token gift, just saying, like, thank you for joining us. Like, our job is to be great for you, things like that.
No, it doesn't need to be a gift either. Like, there's just different ways to do this type of work to, especially in the early days, to get people to recognize your brand. And so whether you're doing non-scalable stuff online, and that may be like manually writing Reddit reviews, or like manually, like, going out and like emailing people individually because you can't automate it effectively. Or it could be like, I forget the name of the company, but there was a company that was starting like an Uber Eats competitor. I forget what it was, but they had a street team at BART in San Francisco and would hand these like free lunch coupons to everyone that's coming out of BART. Like, obviously that's expensive. You can't scale that for very long, but to make a big pop, you get like, there's, I don't know, 500,000 people commuting in San Francisco every day. Like, if you get them to recognize your brand and helps, build awareness really quickly. So I think that stuff's really, really valuable, especially in early days.
So early days, we've seen 8 people Dribble, bootstrap, right? So Andrew buys it, but did he not put money in? And then how did you make sure you got enough runway, essentially, from him, either cash or like a leash as sort of him being, I'm sure, chairman of the board or something like that, to say, hey, look, it's going to take a few years to get this going. Like, how did you work the board in a way to make sure you had the time frame necessary to really build something?
That first year was pretty crazy. So we bought the business and had zero cash.
Okay.
And so after we had to take a loan we didn't know what we were doing. So Andrew was like building a holdco before we knew what a holdco was. And so we're just trying to like build a business, right? Didn't really know how this works, was just like, we were just ignorant to it at the time. And so I literally just took a loan, like a shareholder loan from another business inside of the holdco to make payroll. And so they said I needed some cash until the cash kicked in, and then I could make payroll. And so we did that, paid back the loan. We got a call from a company called Crew. And this is like, I think I stepped in the end of 2016, early 2017, I joined Dribble. In like April, we acquired this business called Crew, which was part of Unsplash, which is this large like stock photo.
How do you acquire any company when you're taking a loan to make your own payroll and decide we're actually going to acquire someone else? Like, why did that even become if I were in your board, I'd be like, that sounds like a distraction. You got to just figure out your own stuff first.
Yeah. So Unsplash was spinning out of Crew. And so there was like 13 people in this business, which was like a freelance marketplace, design marketplace. And they were in distress, right? And so they needed, to join the team, be acquired. And, the Unsplash founders were going off to go work on Unsplash. So anyway, we worked a deal. It was an all stock deal. That's how we were able to do it without cash. We used dribble stock to buy this business, and then took that business from like 13 people where it was operating at a burn and got it down to 4 people or 5 people. I think 4 people, and that 4 people became like the core team of dribble for like the next 7 years. And
How quickly did you do that? Like, so
before close, we had to get a profitable. So that's kind of a golden rule with everything I do now is like, I just will not buy a burning asset. Like it has to be profitable day one. And so I'll write that into the terms as one of the things we did. We made a condition to close with Creative Market when we bought that business that it had to be profitable by the time that we bought it. And, that also kind of puts like the onus of the layoff on the existing management to, make that happen before, we kind of take over as new owners.
yeah. Okay, so you start buying these companies. What other things did you do to start getting this to profitability? So you're cutting costs in different ways, but cutting costs doesn't necessarily mean you're going to be able to grow. What are some of the things you got Andrew to approve, or you were able to just keep doing to get that growth engine going? Because Dribble kind of took off pretty quickly after. I mean, I don't know how you got started with it.
My instinct with Dribble. So I bought this business, Crew, got it profitable, and then it was like, it's like doing like 70 or 90K a month or something just really quickly. Like it was like, oh my God, like this thing's like just cash flowing. And we just let it run until it didn't run anymore. And then I brought the team into Dribble. But my instinct kind of growing up in Silicon Valley was to go, do the dog and pony show down on Sand Hill Road and raise venture capital. And, I got meetings with, top 15 VC firms in the world, and, got very close to term sheets with a few of them. And during that month and a half, 2 months while I was, really focused on fundraising, we became very profitable. And like, so revenue just, our expenses were flat and revenue just started to grow. And so with that revenue growth, it's like, oh man, well, we're having this growing profit margin. Maybe we don't need to, take this VC check. It's at a crazy valuation. I don't even know what we're going to do with all this money. And it definitely changed our course, right? From like being in control of our destiny to now we're on this VC clock where we have to sell the business in, a certain amount of years at a crazy valuation. And so ended up not, just kind of walking away from the VC route. And it's kind of the same logic of like, I took over Dribble. I'm like, oh, we need an office in San Francisco or Oakland. And then I started to get those, look at how much that would cost. I'm like, oh shit, maybe we'll just stay remote and see how long that, we could be remote until that breaks. And it's kind of the same thing with like the venture capital raise. Like, oh man, maybe we'll just stay profitable and see how long we can grow being bootstrapped until that breaks. And then we've always raised money later, so that was kind of the mentality. And then, fast forward, 8 years later, we just stayed bootstrapped along the entire course and never had to bring in outside capital.
Is there ever a point where a company, if they are profitable, and I know that's more of a thing that companies are going for nowadays, which is a good thing, where they should take on like VC dollars? I mean, so I'll give you an example. Like even for Chore ourselves, I have VCs reach out. We're bootstrapped. And they sort of say like, hey, we want to put money in. I'm like, look, I'm not interested until I feel like either our own revenue can't support our growth, or I feel like the growth opportunity is so big and we know how to scale it properly that like you put money in and I know exactly what I will turn that money into, and then we're good to go. And yeah, like then it's worth taking on that because then we're off to the races. Is that the right mentality, or are there other times when to think about like when to take on that VC money?
Yeah. I mean, it's I think it's like, I don't think it's right or wrong. I think it's math that you have to do as a founder of like, okay, if I take this capital, how would I use that capital? And I think there's too many entrepreneurs who look at like raising money from VCs is actually the goal. And like, no, actually the goal is, what you're going to do to make money, right? And actually generate income. And so like, I don't know, like, I think if you do the math, I remember like Aaron Levy, by the time he IPO'd Box, he had like 5% of the business. Yeah. And I think that was still a great outcome for him, like in terms of like, financial stability for the rest of his life.
Changing money for him and his family and everything else for forever, basically, even with.
But he had all these investors. He had IPO. Like his life became just like, and I don't know him personally, so I'm just making this up, but I'm just like imagining his life just became so much more complicated by taking that path versus could he have gotten the same outcome by being bootstrapped and then having 100% of the business and selling it for the same amount of money he got from the 5%, but through that whole like, VC backed juggernaut IPO story arc.
Right. That's the question, right? Because the cost of, I'm sure you would say, well, the cost of senior account executives who need to go close these deals, but it takes 6 to 12 months to close these big enterprise deals.
I don't know these guys. And so I'm just like using this as an example, but that's kind of that's my framework as I think about this stuff is like, what kind of life do I want to live? And like, how much pain am I willing to go through to get to that end goal, that outcome? And, in a lot of cases, like I think a lot of founders don't realize how expensive it is and like what you're actually signing up for when you cash that check, because it changes everything.
So what do you tell then founders if you're advising earlier stage founders to think through those questions? Because there's an alluring aspect to taking venture dollars, right? There's a little ego boost to some extent. But then also, like in some cases, you need it because you're making these investments. You got to hire these expensive engineers and salespeople, and that's the only way your company's maybe, at least you may imagine, the only way it will take off.
Again, I think it's a personal decision, but I think a lot of founders don't really understand what they're signing up for, to be honest. And you shouldn't take even like, it's funny, they're called safes because it feels safe to go raise a couple $1 million in these notes and have some cash in the bank to move you along. But look, the most optimal position in my mind as a business owner is to own 100% of the business. And that's the ideal. You don't have partners is ideal. Ideal, you don't have co-founders. You also have like countering forces that could be working against you and just making your life harder. At least that's like from my, my experience kind of looking in hindsight is like, this just complicates things. And, maybe 1 out of 10 hits the gold rush and it's a rocket ship. But in so many other cases, it just makes the founders and the management team just miserable.
Just to play devil's advocate quickly. I mean, I tend to agree, right? I don't have a co-founder for Chore. We're bootstrapped, but it took me 3 companies, this is my 4th, to figure that out. How does that work? I mean, like, a lot of people would say, maybe Andrew as well, I've read his book, right? That having a partner to do this stuff makes it so much easier and better. If you have the right partner, you can go that much faster because you're in it together and you're focused on it in a really hard, strong way. And that can more than double your output, right? 2 + 2 doesn't actually equal 4. If it's like 2 top tier founders who are both in it, it probably equals 8 or something. What would be the alternative to that? I'm CEO, like it's hard being up here, like where people are like, here's this issue. And I'm like, shit, I just got to decide. There's no one else in it. That's freeing, but it also puts a lot of extra pressure there.
The co-founder marriage in Silicon Valley was really because the business guy who knew how to scale the business and the technical guy who knew how to write the code, that was the partnership that had to come together to make that work. And they support each other and all that through that journey. And I think just we're in a day and age today where you don't need a technical co-founder. You can hire, agencies, you can hire individual freelancers, you can, vibe code an MVP. So I think there's just solutions that didn't exist, 3-5 years ago, where just the logic was that you should have a co-founder. I think if you're a type of person who's not driven, is not going to wake up every day and like go work at this problem, then maybe you need somebody to keep you honest.
Be an entrepreneur in general, if that's the case. If you're not driven in general, then don't go be an entrepreneur, at least in a high tech space where growth is somewhat expected.
Yeah. So I mean, I just think what is the most optimal number of employees in a business? It's 0, right? You have no payroll costs. The most optimal amount of equity ownership you want as an entrepreneur is 100%. So when you add co-founders, when you add investors, and it just dilutes you over time. yeah, maybe it'll grow faster and maybe you'll get to a bigger overall enterprise value in time, but you also just have to pay attention to that dilution. That's kind of
So thinking about, I mean, equity is an interesting one. What's your opinion about giving equity away to the team, right? If you're saying, hey, 100% is ideal, what about giving equity to the team who's there with you on this journey, trying to build this company? It's still in giving. If you own 90%, I think that's still pretty good if you give 10% away to your team. But what is your thesis there? And then I want to dive into culture a little bit too, because you built this great culture at Dribble.
No, I think it's fair. If people want stock options, I think it's good to have a pool and have people feel invested as owners in the business. But in my experience across multiple startups for many, many years, is that people just don't understand stock options and they don't really understand the mechanics of it.
I don't understand. Do you mean like they don't understand the technical aspects of what it is, or they don't understand the value prop of it? So
they don't understand, like, okay, what does it mean to have like X amount of shares? Like, they don't even know how to ask the right questions, right? So I think like giving it away as like an incentive, this concept was really invented as a way to compress salaries and give an alternative compensation. And so I think if an employee wants stock options, it needs to be framed within that type of math of like, okay, well, like if you want this crazy 6-figure salary and you want this, this equity package, like the sum of those two parts, and let's talk about that number. So yeah, I'm not against it, but I think like giving it out willy-nilly, like most ICs and like most like, junior employees just have no idea.
It's a really interesting point. We give equity at Shore to everybody. The thesis being, I think I want people to participate in the upside that they're hopefully helping to build and understand that there's some upside for them. It also, I tend to believe very true that the only way to really make real money long-term for your family is owning an asset overall. It's not just getting a salary. But on the other hand, I think you're also totally right where most people just don't really value it, don't understand it, don't think about it. So I do struggle with saying, hey, should we even do it? What's the point? But I know I've personally been in the place like, hey, I want people to have it and at least participate in the upside of what we're building.
I think it depends on like how much is the grant, right? I think when you do understand how stock options work, I've been an employee and received stock options like, oh, I'm getting like 1% of something that's could be valued X in so many years. And so you do the math and it's like, okay, is this actually that valuable and will it increase in value? And then, okay, what's my strike price? Where am I actually going to have to pay for this? What's going to be my tax obligation once I, convert this equity? So it's complicated. If I leave the company, what's the time that I have to buy that equity before I, lose it? So it's a complicated thing that most people don't, unless you've been in the industry for a long time, they don't wrap their head around. And I don't know. I think it's better just to pay people well, give them cash and like give them a mission they believe in. And that usually is.
I mean, I agree also with that. Like in the end, the mission's far more important. At the same time, like, if you're one of the first 1,000 employees at Google or at Meta and you got equity in those companies, even if it was a teeny tiny percent, that's life-changing for you. Now,
owned a farm in Nevada City that had a gold, struck a mother lode of gold. Like, yeah, I won the lottery, right? And it's the same thing with those companies. You never know, but 95% of startups fail. And you have to look at like every year you're spending your life and like, you should be just mindful of what you're signing up for. It's the same thing with like raising money as an employee. You should be, mindful about how much you're working for equity and in the startup, I think.
So then how did you create the culture at Dribble that you grew from 500,000 users to 20 million users? So you went on this growth tear. You said no to VC dollars. And you did this fully remote. How did you build this seemingly great culture fully remote?
I kind of just selfishly built the culture of a business that I wanted to work for, right? And so by being the CEO, you get to kind of design and shape what that looks like. And, I wanted to spend time with my family and be able to pick up my kids from school. And so I allowed my employees to do that. We had a guy in the team who would go coach his, kids softball at 3 p.m. and then come back and finish up work at night. And like, I'm not monitoring when people are working as long as the work gets done, right? And so by giving people that freedom and responsibility, and we also just hired like really good people. So the bar was really high with hiring. And then once you were on the inside, then we really just had a culture of trust and transparency. And then, I think that there was, the Mercer Meyer, like, yeah, when she took over Yahoo, there was like a butts back in seat thing. And there is this like psychology with managers where they want to see you working to like feel like work's getting done. But we early on, we're all using Slack. It doesn't matter if we're in the same office or like remote, we're all using the same digital tools anyway. And so like with daily stand-ups, with like, check-ins of like task lists, you can see like who's pulling their weight and who's not. So anyway, so I just like kind of leaned into a culture of like, yeah, like was into rock climbing and lived in her van and had a satellite internet set up.
That was before SpaceX and all that stuff.
Or SpaceX. Yeah. So she would like go to like, across Utah and just park her van and like would work for like 4 hours a day and then go take off rock climbing and do her thing and then, come up and finish us. So anyway, that was, and so you listen to that and something like, okay, that sounds like a cool place to work. And that's really the vibe that I was trying to push the whole time, is like, how do I really hold people accountable for like, yeah, you have to do your work, but I also want to this not to feel like a regular 9 to 5er where you're just like dreading, having those like Sunday scaries and like, oh, I want to kind of go back and have a, day full of meetings. Like we did things because I noticed that coming from, working in San Francisco in these big open office spaces, it's just it's hard to get actual work done. Always input in meetings. There's all this noise and distraction. And so when we went remote, we actually did like Thursdays and Fridays, no meeting zones. And we had rules like, okay, if somebody sends you a meeting and there's no agenda inside, it's okay just to cancel it. So we did stuff like that. Really, I'm just like pulling this out of my ass and like being like, okay, let's just try this concept because I think it's going to make everyone happier and more efficient. And it'll work for a while. Then we change something up and we like, adapt and like evolve. But, trying those things out really helped like also just make people think like, okay, this is at least a CEO who cares about, me as an employee and what we're doing here.
Were you in touch? I mean, how big did the team end up getting at Dribbble? And like, how many people were you in touch with everyone in the team on a regular basis? Did you do like monthly all hands? How did you take care of that stuff?
Yeah, weekly all hands. So being remote, we wanted to stay in touch weekly, and I'd have, functional teams give an update on everything, like every project. Like everyone in the company needs to know what every function is doing intimately so that we're all on the same page. Because the worst thing that can happen, like I've worked in companies where it's very much like secrecy and like you just don't communicate and like it's just like a death zone. It's just like worst thing you can do for culture and for productivity. The more that people are plugged in, the more we're all swimming in the same direction. So that was a weekly thing. I had one-on-ones weekly with my direct reports, and then I would like quarterly meet with everyone in the company. So we grew up to 100 people at one point. The company's probably like 20 or 30 people now. But we split out Creative Market. So we bought Creative Market, which came with like 70 people. We brought that team down to like 50 or 40. So it's evolved over time, for sure, as we made acquisitions and people have come and gone. We've gone through hiring sprees and good times. We've had to pull back on and do layoffs and hard times. And so it's just part of like a business that's been around for a long time. You kind of have to go through these like cyclical phases. But along that, there was always like the core team who was there for, my entire tenure.
In going back to the remote stuff, do you recommend that to companies today? Is that still a mindset? If you're like, hey, like, what do you recommend to companies starting now? Remote only, remote first, be back in the office, or what are the variables?
The only people who can afford office space in Silicon Valley are AI companies. And so if you've raised, $100 million, go for it. But otherwise, if you're a small startup, it just doesn't make sense to have office space. I think in this day and age, like, if you feel like you need to be in the same room with your co-founders, meet up at a WeWork or whatever and do your thing. But it's real cost, it's real overhead. And I think in 1995, Sandra Bullock was on the beach poking around on her laptop as a hacker in that movie, The Net. And so that was always like this like dream of like, oh, there's this internet thing you could have a business on and make money from the web. And it just took us a really long time to get to a point. It took us a global pandemic to make us wake up and realize that, for most online businesses, you can do it from your couch.
So I totally agree, but yet I find so many companies are looking to have people in the office. Like it's very much gone back the other way, where it's like, we want people in the office, not just big companies. And I think some of the big companies are doing it for questionable reasons. They're trying to kind of do fake layoffs, even for the startups. And they're like, I'm going to pay 2x the price of someone in San Francisco because I want someone in the office with me in San Francisco. So it's going to cost 2x the amount, or more like 10x the amount if you look overseas. And yet they're doing that. So when you go buy these companies, and I want to talk a little bit about acquisitions and what it look like if you're a founder looking to sell. Do you go in and say, hey, look, we're gonna jettison this entire office, and anyone who will stick around, like, cool, but it's going remote, like right there, you're saving 10% of your title expenses because you're getting rid of this expensive lease.
Yeah. So, I mean, we structure our deals in a way that we don't take on the leases. And so, getting out of leases are a very important part of the deal because it's a big part. It's a big cost.
I didn't even know that was possible. So if you're acquiring a company, there's some provision somehow,
you can buy the asset for the business, right? And you don't have to buy
who then still has to keep paying the landlord. How does that work?
Yeah. So it's just part of,
part of the deal. Somehow they figured out you're like buying the assets, not your full office.
Well, every deal is different. You have to look into the contract and see if this is possible. And there's ways to do it though.
For you guys, that's one of the first things. It's like we're not paying for an office.
Is the office space $1,000 a month, or is it $40,000 a month? At Hired, we paid like $250,000 a month for that spot on Market Street.
I went to that office. I can't even imagine now.
Yeah. So it's definitely, it doesn't make a lot of sense for most businesses. We see a lot of legacy businesses where they have an office, and even in those legacy businesses in these day and age, like half the team still working remote anyway, because it's like office optional. So it's just like a wasted cost in my mind. And I think 90% of software companies don't need to be in a centralized office.
Yeah. So that's one of the things you do. So then let's talk through a little bit about acquisitions, right? So you move to this world, do Dribbble, you've had a successful company. What made you go into the acquisition, looking into like enduring ventures, acquiring companies? What does that look like? Why? In what has changed in the world where that becomes more of an enticing option? And like, when should a founder think of, hey, maybe I should sell my company?
When you raise VC and you go down this path as a founder, like there is no option other than selling your business, right? That is what you're signing up to do. You will sell your business in the next, 5 to 8 years. That is the goal. And so, I stepped out of Dribbble. We had some successful acquisitions, stepped out last year, really around this thesis that there were a lot of businesses that became overcapitalized during the ZIRP era, right? So there was a very low interest rate. There's a lot of private capital that moved into private markets, and that created competition and drove valuations up. And so you had these 5 million ARR businesses raising at, crazy $200 million valuations. And that's kind of left the founders in a position where they're stuck. They're on a treadmill, they're running a business, but they've been completely crushed by their preference stack of their preferred investors. Maybe they've taken on some venture debt and they have principal payments coming due. So there's just a lot of businesses that, because of their financial structure, they're good businesses, real revenue, happy customers, but just broken economics, broken cap table, broken balance sheet. And so those are the types of opportunities where, we can come in and find a creative M&A structure that makes sense for everyone and resets economics with the management team.
And so when, as a founder, is the time then to start thinking about that is when you feel like, hey, the preference stack is kind of crazy, the business is treading water to some extent, and it's a time to think of some sort of exit. When does a founder even start saying, I need to go find a buyer? And then what sort of buyers should they look for? Like why, not necessarily why.
A founder should never be thinking about an exit when times are bad. You should really be thinking about an exit when times are good. That's how you're going to maximize the valuation, and that's how you're going to have a better story for the future. To be frank, like we shouldn't be the first number you call when you're looking to sell your business, because we're not going to pay top dollar, right? That's not just, it's not the business we're in. And so, yeah, I mean, when you're selling your business, it should be a very much a multi-year planned, calculated, some point in the arc of growth should be when you're looking to sell. And that's typically private equity. Unfortunately, the M&A market has dried up significantly, and there's just less buyers out there than there used to be.
I mean, capital's pretty, I mean, there's a lot of capital out there right now looking for places.
Yeah, it's just where investors want to invest, right? And so, a lot of the venture attention has moved away from kind of traditional SaaS, and there was, 1 year is like the creator economy was the new it thing. 1 year is like Web3 was a new it thing. And now we're in this AI bubble, and even Sam Altman is like a signal that we're probably in a hype bubble. So I don't know what the next thing will be, but I think we've seen a lot of venture move away from, other types of software companies to go focus all on this kind of next gen, wave. So yeah, and then in private equity, I think it's, the private equity model was heavily reliant on, having lower interest rates to buy some of these bigger targets, and then, finance them in a way that you can grow EBITDA and then sell into another private equity firm. And that was a game that was being played for many years. And I think that has slowed down. The IPO market has slowed down. So there's just a lot of macro forces. There's a lot of uncertainty in the global economic future. The dollar is depreciating. There's just inflation. There's a lot of forces, right? That's just causing a lot of uncertainty. And so when investors are uncertain, they don't know where to put their money to work.
So then, as a founder, going back to your point about, hey, the best time to sell is when you're doing well. How do you actually make that decision as a founder? So in other words, if you're doing great, you have this ego, we're crushing it. We're getting VCs who come and tell us we can be $1 billion company, et cetera, et cetera. It probably takes a special kind of founder to say, okay, this is actually the time to exit and get out. Because as a founder, you spend so much time eating your own maybe BS about how great your company is going to be and how big you can become in this massive market. And so, and then how do you exit? Because I'm sure you and I have both seen so many companies who try to go huge and they totally fail at some point. Something goes wrong and they miss that window, and then they never have an exit.
As a founder, you should build relationships with multiple really great investment bankers. As at Dribble, I reached out to LionTree and Morgan Stanley and these really big firms that are willing to do these massive deals. And they're they took meetings. They're really nice to me, but they're kind of okay, you're kind of star-eyed that, you'll probably never need to call us. But then I met other bankers and just built those relationships over the years.
In your mind, I need to build relationships with bankers to prepare ourselves for.
It's just it's part of the puzzle. If you're building a startup and it's growing, you should be building those relationships early with bankers, even if you're not going to sell for 5 years. That relationship with the banker, they'll meet with you and give you market signal and try to these are the people who will find you target buyers. You could do it too as a CEO. It's just much harder. You're just not going to know the market as well as, somebody who's sold 4 or 5 businesses in that particular niche. They've already run the process multiple times. So they know all the buyers. They know them. They've gone out to steak dinners with these guys. They know who is looking for what. So I think that's really valuable. I've had good and bad experiences with investment banks. I've worked with really, really hardworking, awesome, really smart, just financial advisors on a banking team. And I've worked with really just tuned out, just wasn't even plugged in. And so we've had to fire multiple investment bankers over the years. But no, I think that's part of the job as a CEO. Is you need to, build those relationships.
How do you identify the good bankers versus the bad. It's like if you're rule of thumb for you in your mind on both sides of the table, what does that look like? Because this is an area most founders have never gone through before. It's like there is no playbook. I don't know. You probably can ask AI to help you do it, but like what you've actually experienced it. You've done kind of acquisitions.
Yeah. I think it's personal preference a little bit. Finding some guys that you trust and vibe with. But also it helps that if all these firms list the deals they've done on their website. And so if you can find a firm who's sold similar companies, even like, loosely similar companies to yours, they will just have a better grasp of your industry and who the players are in the space. And that's the value they bring.
Yeah, no, that's okay. So you're just trying to find those guys to some extent.
You should chat with it, right? Like, hey, this is my business. Give me a list of 10 investment banks that have done deals in my space, right? And they'll probably state you out a list.
Yeah, and sure, that's certainly the initial way to get started. What are other key things when you think about, like going back to the dribble days, but the companies you also acquire when it comes to figuring out who do you keep at the company, who do you fire, who do you let go, how do you hire the right way at these companies to redo? I'm guessing when you come in, the team might not be that ecstatic, right? Everyone's getting recapped. The company clearly isn't crushing it. So like, what do you do to turn those companies around and rally the troops to go build some brighter future?
Look, I mean, every situation is different. I will personally sit down and have one-on-ones with every single employee, all the way down to like the customer support folks in the Philippines, just to understand what is their day-to-day and what's their contribution to the business. And when you're a venture-backed startup, you kind of have to like invent roles to be able to spend the money. Because the game is almost like you raise an A round and you have to burn through that round to go raise your Series B, and you just continue to like push that EV up. And so there's a bit, with a lot of these businesses that we look at, there's just a lot of bloat, and a lot of that's in like the middle management, where they built this hierarchy of an org, and there's like multiple teams under that person. There's teams. I mean, these people, like everyone has a team, right? Like, and everyone has a team. There's a lot of waste typically. And so yeah, I mean, when we're buying a business, and, especially buying a business that has like, call it 10 million in revenue, but is like burning money, the number one goal is, okay, how do we take this business from burning money to making money? And so that's just a cost cut exercise, and it's payroll. It's cutting out, who are the expensive salaries? Maybe we don't need like an 8-person exec team. Can we get by with a 3-person exec team? Really understanding who are the people day to day on the front lines, like talking to our customers, actually building product, actually contributing to revenue, and who is like, basically a pass-through entity. And so you make those cuts. You make cuts to, you go through your dues and subs, your software, your AWS bill, your Stripe bill. You're just renegotiating with these vendors to get everything to optimize. And that's kind of step one. Step two is if revenue's in decline, you got to get to flat, at least to flat, as quickly as possible. So you have to go, sometimes it's like, okay, we're going to build a churn squad. You guys are just going to tackle churn. Go fix this. Sometimes it's like, it's a go-to-market squad. Okay, you guys are doing B2B sales with a product that has a $1,500 lifetime value. Like, that's just a bad way to bring this company to go to market. Let's go focus on this other channel instead. It's like way cheaper than hiring like a 10-person sales team. Let's go focus on marketing instead of sales. So sometimes it's that, like, let's go get new revenue in the door. So, so that's kind of like, it's cost cutting, it's revenue stabilization. And then over time, you build the foundations for the next way of go to market, and that builds the foundations for you to be able to grow the business from there.
So sort of you go through these painful things right in the beginning, people will start, hopefully, so right off the bat, people start seeing that hopefully some improvements, the people who are still there say, okay, this plan is working. Hopefully that seems like a really simple, straightforward plan. So why is it so hard for the founders?
Very, very painful.
It's just they're not they're just like they're too in it. They know everyone too well. They just can't.
Exactly. Yeah. And like, for a lot of, executives, like when you hire, you put the band back together, you're pulling your close friends from your network to come join you in this mission. And so you don't want to fire your close friends once you put the band back together and things don't turn out the way you thought they were going to turn out. And so, yeah, I mean, that's a common thing we see is like the solution is you need to cut this payroll in half and maybe they'll do like a 10% cut. It's like, okay, that solved the problem. You're not doing the work that needs to be done. Like, and it sucks. It's people's jobs and it's really painful to go through that. It's business at the end of the day, and like whatever it takes to keep the company alive is what you need to do.
In a sense, you're doing the right thing for everyone else who's still there because they still will have a job versus saying, hey, this whole thing's going to go under and everyone will lose their job.
And we've done that. We bought a business in November and had to cut, a good chunk of the business. And the people who were left were just so happy to continue to work on the product. They love the business. They love what they do. Like we had like zero turnover from the staff in the last year. And, the people who were left were like, yeah, the people you cut, you're right. It didn't really do much. And so thank you. Like we're way more efficient now. Right.
It seems like that's the case all the time. People are like, yeah, we all knew those people weren't getting it done and we're just need to be more strict about it. So how do you make sure then that like that rot doesn't come back? Like, okay, you bought this company a year ago, November. How do you make everyone's happy, but you start getting lazy, you're growing again, you start hiring more people. How do you keep things lean and focused over the over enduring long term?
So every business is different. Every leader is going to be different, but you need some type of like measurable goal, whether that's a profit margin, whether that's a percentage of annual growth or month over month growth, whether that's a revenue per employee number, whether that's, so there's different ways to like measure it to keep you from, getting lazy and things falling apart. But like, I mean, your literal job as a CEO is just to focus on that shit. Like you shouldn't be doing anything else. Like everything else should be delegated to your team, at least to some revenue level. And your primary job is just to keep the train on the tracks. Keep it growing, keep it profitable, keep it sustainable. Like that's it.
And is that the type of CEOs you put in place in those companies saying, okay, that's your goal, like focus on that?
And so we hire people and we incentivize them to be totally aligned with us as owners. And that's, I don't get paid until we have profit and that profit is distributed. And so, that's how I make a living. And so if a CEO is reinvesting all the profit back into whatever R&D or what, then I'm not getting paid. And so then no problem. So
going back to you personally, we'll do a little bit of lightning around quickly for the next few minutes. When you think through your own personal day-to-day, either at Dribbble or the companies you go into, or just your day-to-day in general, how do you decide what to focus on when? Like, what is your own heuristic for where to spend your time and how to do that? Because it's very easy to get distracted, right? Not only just all the digital distractions that exist in our life, but even at work, there's like, this is a burning fire, this is a burning fire. What do you decide to focus on and why?
It changes daily. I think, what I do every morning, and it's been a habit of mine for 25 years, is I have a bunch of, you can't see it, but I have sticky notes all over my desk. And I like them because I like to just like the tactical feeling of crumpling them up and throwing them in the trash when they're done. And so I've been doing that, for decades. And it's just how I get organized in the morning. So I set my day. My calendar really drives me as well. And so I have meetings and calls, and I have a Calendly. So like random meetings show up in my calendar. So I'm like, shit, I thought I had an hour to work on this thing. And then I got to hop on this call, and so that
block your calendar link. So it can't book ahead of time. You have to get,
we have to, but then, you get just stuff, you get distracted just by just business. Right. And like, or like something catches on fire, like, oh, well then I'm not gonna get those 5 things done tomorrow. I'm gonna have to focus on this one big thing. And that's just how it goes. Right. And so, there's a lot of frameworks and apps and tools and methodologies. And I think it's all bullshit. Like everyone deals with these problems, and you just have to like take them one day at a time and prioritize the best you can, get the important stuff done first, and everything else will get done when you can get to it.
But do you think there's certain things that set you apart? Because you've been so successful in so many different areas in different sort of businesses that enable you to be better at focusing or knowing what is the big problem
I have ADHD. I have I have actually impairments that should keep me organized and on task. I think it's really like a sense of urgency, and I have a bit of an aggressive personality. I'm very goal oriented. And so when I set a goal, and it's very long-term goal oriented, so I'm like really looking long-term. This is where I want to take this. And I set this aside of that's the North Star. That's the path we're on. And, you're going to get off that road as you go and you're going to figure it out. But as long as you keep going towards that North Star, you're marching in the right direction. So I don't know. I don't think I'm very different from a lot of leaders in that perspective. I think that's just, that's part of it, is like really trying to understand like what is the outcome that we're all working towards, right? And that outcome could be different for different people with different, depending on your situation. So I think really defining like what does that outcome personally look like for you, for the business, for the team, whatever, like your situation, your investors, that kind of dictates where you go and how fast you have to move to get there.
So speaking of long term quickly, without getting too distracted by this question, how does, and you're closer in the tech scene, how does AI change your long term perspective right now? And what do you see it? How do you see it changing what companies you buy, how you buy a company, how you achieve enduring success with it? What is it doing to that market?
So I haven't seen the acceleration of innovation as fast in my lifetime, in my career. I've never also seen the uncertainty in the market. And I think everyone agrees like AI is going to change everything, but there's like, we are like polarized, and it's going to make us into these, supreme beings where, everyone no one has to work anymore. We just get back. I'm like, or it's going to be like this dystopian future of like, it doesn't take that much imagination to extrapolate a few steps into the future of like the different paths that this could go once this kind of goes off the rails and we have like insane amount of automation.
So I agree, but at the same time, it feels like everyone has this imagination, yet they're still going about things sort of the same way they were doing it a few years ago. Like nothing, it doesn't feel like anything's changed dramatically. Like, sure, things have sped up and use AI for new things, but like we're still mostly leading the same lives we were a few years ago.
I think that we're going to see unemployment rates. I think we're going to see real productivity gains that will fundamentally change things. I think we'll see markets and industries obsoleted. And so as I'm looking at businesses, I'm looking at like MarTech businesses and like, what are businesses that are entrenched in organizations like ESPs or like, affiliate management software or like, just things that have been around for a long time throughout the history of the internet and will likely still be a part of businesses into the future. I'm looking at businesses that, can become more efficient with AI. I'm looking at businesses that the product can shift into an AI powered product, right? And bring that to market. So you have a more efficient, tool set. So and it's hard, right? So it doesn't like really pop out at you. You really have to start to like look at a business and have an imagination of like, okay, where can this kind of go and fit over the next, I think that 5 years ago, you would have this like 10, 15 year lens at the market. And now it's like 3 to 5. Like, I don't know how it's going to shift out. And we're just moving so fast that it's hard to kind of follow along.
Does that change then when you make an acquisition? Like you want to flip it faster, or you're still trying to build these enduring companies? So
we don't underwrite to flip. We underwrite to hold sustainably over time. And, and we structure in a way that, even if we're successful the next, 3 to 5 years, we make our money back. And if we go on longer than that, then we have all that upside in the future. But yeah, and I think it's anybody's guess. I think AI is like going to change society, and we're going to have like this amazing superpower. I think what we're playing with right now with the ChatGPTs of the world are very novel and like the very early like MS-DOS version of where it will be in like not 10 years, but like in a year or two. Blow our minds in like a year.
So a few of the last quick questions for you. One, when you think through like work-life balance, unity, whatever you want to call it, how do you think through that as a founder, leader, investor? There's a lot of sort of 996 discussion again. So looking back, like working 6 days a week for I think 9 hours. I think what 996 is. I'm right. 9 to 9. Sorry, 9 to 9 for 6 days a week. How does that fit with what you think about for companies that can be successful?
It's like a China and Elon effect that's hitting Silicon Valley. And like, I think it's an unsustainable schedule to grind people that and set a culture to grind people that long. I mean, I definitely grew up in that environment and definitely felt burnout through doing that. And, not feeling like I could go home until the CEO leaves. And like, I just think it's unhealthy. I think I do get it. Like if you're in a race, again, you're raising money and you're playing for pole position. You have to be the number one winner in this race or you lose everything. Then I definitely get like why, folks in their, it's people in their early 20s who can do that for an amount of time, but I don't think it's sustainable. I think as soon as you do like 5-10 years of that and it's just pretty crushing. You bring kids or a family into the picture, it becomes very unsustainable. You really start to get like, again, it comes back to your outcome, right? Like what's the outcome you want? Like you'll grind like that if you think like your outcomes, like the time you're committing right now in your early 20s will become a winning lottery ticket once this company goes public. If that's your belief system, that makes sense to make that investment. I think that's also fine to have like an outcome of like, hey, I just want to, my goal is $5 million in the bank when I retire, and I'll, and that's what I need to live a very, happy life into retirement. I think there's different lenses that somebody can have and like goals and like I don't know. I don't like that grind mentality. Never have.
What's the outcome you want in your life? Just you personally?
It's what I have, right? I have freedom. I have freedom of time. I have financial freedom. I have like that's really what I've been working on for my whole life, and it's given me the mind space to be able to think about where I want to focus my energy. And like, there's a million ways to make $1 million in America. Picking the path that's going to scratch your personal itch and like something that you'd actually enjoy working on, and and put your energy to learn something new, or like to or to put your skills in a place where you can actually 10x the outcome because this space better than anyone else or most of your peers. I like taking my kids to school. I like having being around my family during the day versus being in San Francisco or being in a car during a commute. Those things that are important to me is my family first, and then my friends, and so having control of my schedule, my time, and what I work on is a luxury.
And two last questions. When you think through advice you would give your much younger self, what would that advice be?
I should have made the plunge sooner. I think I was very much risk adverse to doing stuff myself. And I think that I've had success over my career, and I've had a lot of like very fast growth that imploded right at some point in that story arc, and lost a lot of years to those journeys. I learned a ton, and so it's worth it all. But I also think back, like I think I have regret of like, okay, why didn't I just start a company when I was in my mid-20s, and just I could have been building that over the last 2 decades versus doing all these different startups. And
do you think just because you were risk averse, you didn't feel you're financially safe, or
the knowledge that I have today, I think that I was coming up in my career, and so in the that time, like to take a job at a Silicon Valley company and like ride that wave, like that was the thing to do. And so that's what I did, and versus like going to YC and like starting my own thing. Which
are there and then the other question to ask everybody is there what is your single piece of advice that you would give to every entrepreneur today to be excellent? What would you break that single piece of advice down into or towards?
Here's what we just talked about, right? I think it's like understanding your outcome. Like, what's your personal goal? Like, where do you want to be in 5 years? There's Milton Glaser is a famous designer who was a professor for 50 years, and he's the guy who designed like the "I Love New York" T-shirt and the IBM logo, a bunch of stuff. But part of his class was he would ask students to write an essay of where do you want to be in 5 years. And I think that's a really important just exercise for all of us to do, is really take, because we can get lost in our journey and our jobs and whatever, and you lose scope of like, am I living the life that I actually want to live? Am I heading on the right path to my outcome for where I want to be in 5 years? And so I think, as you know, if you choose the path of an entrepreneurial life, it's because you want a certain outcome. So what is that outcome for you? And you better know it, because that's, otherwise just go take a job and go.
So many people don't know what that outcome looks like, and it's almost harder to do that 5-year plan or 10-year plan than it is to go start a company in some ways for people, because you almost have to be realistic with yourself and think, it's a question to go through your stuff. Just think through these issues yourself and target that. And that's tough for people.
Yeah, no, it is for sure. But I think also just having a North Star, right? Like, you have to have, if you don't know your outcome that you're working for, at least have some like goal for the business or something that you're working towards. And that should dictate every move you're making so that you're heading in the right direction, because it's really easy to fall off the tracks.
Totally. Zack, how can people find you, get in touch, learn more about Enduring? What are the right ways for folks to find you?
I'm Zack 415 and all the things. So
amazing. Thank you so much for the time. I really appreciate it. My audience does as well. Time is precious, so thank you for spending some of it with us.
Good seeing you, man. Have a good one.